Hello, welcome everybody. You're in the right place. Welcome to the Back to Basics webinar. We're just going to give it about a minute for everyone to filter in, but you're in the right place. We'll get started in just a second. All right, you guys are in the right place. We're just letting everybody filter in. But as you guys come in, I'll go ahead and get started. Hello, everyone, and welcome to our next webinar in the Back to Basics series on bank reconciliations. We're so happy to have you here with us today. Before I introduce our presenter, a few housekeeping items. This webinar is being recorded, so be on the lookout later today for an email containing a link to the recording, as well as a copy of the slides and other resources. This webinar will run for 50 minutes with a 10-minute Q&A immediately following. If you have any questions for our speaker, please put them in the Q&A box located in the Zoom toolbar. To find that, hover your mouse over the top or the bottom of your screen and a toolbar will pop up. This webinar is eligible for 1 hour of CPE credit. We will launch 4 polls throughout the presentation, and to receive credit, you must answer 3 of the 4 polls and also complete the short evaluation you will receive afterwards via email. LSL is using a new system, so please note that the evaluation email will be coming from LC Vista, and please allow up to 1 week to receive this email. If you're having trouble seeing those polls, try minimizing the Zoom screen, as sometimes the poll questions pop up behind it and you have to click around and drag the screen to see the pop-up box. All right, now I'd like to introduce our presenter. Steven Berrett Warnick is a senior manager in LSL's Assurance and Advisory Department with nearly 2 decades of experience serving California's state and local governments and nonprofits. From preparing ACFRs and navigating complex compliance audits under uniform guidance to implementing the latest GASB standards, Berrett thrives on solving challenges that matter. He helps agencies translate technical audit requirements into practical, actionable strategies, improving processes, enhancing transparency, and ensuring smooth, confident audit preparation. Okay, Berrett, take it away.
Great. Thanks, Cami. Well, welcome everybody. As Cami mentioned, we definitely want to thank you for being here with us. We know your time is very valuable. We're glad you've chosen to join us today. Hopefully we make it worth your while, and if at the very least, if not, we hope you get some CPE. But I imagine there's probably I can't see any of you, but there's probably some familiar faces out there. I've been working sort of in the government arena for the last couple of years, or sorry, almost couple decades. My apologies. It's been quite a while here in the California region, and so we may have crossed paths before, and if not, we might bump into each other again later. I know it's sort of a small world here in the California community. If you're outside of California, I'd like to just introduce myself, but glad that you're taking the time here to be with us. Our topic today, of all things, is going to be bank reconciliations, and I know that for many of you that might not sound like a real sexy topic, but it's very important. And those of you with experience with bank recons know that at times they can be extremely challenging too. Bank recons are interesting in the government arena. I've worked a little bit in government and in private, and as you compare recons for the private side of things compared to government, on the private side, they really are very, very much simpler. If you work in government, you might be in a district where your bank recons are fairly simple too, and most of what's happening for you is just running through the treasury or through your city somehow. But if you are in a larger county, if you're an auditor controller or work in the treasury, you know that you almost are housing your own bank. And so it can get very complex also at the same time. And so we'd like to talk about that a bit. We probably won't get too deep into details as far as the real deep complexities that might pop up if you have a treasury and some of the exciting things that you can see. But we definitely want to cover the basics and the basics in a government context. So that everybody's able to kind of become a little bit more adept and get a little bit more familiar. If you're new to this topic, hopefully this will be kind of a great introduction. If you're old, hopefully it'll be a good reminder. But our objectives today, we want to, of course, talk about the challenges you guys run into and face when you're doing your own bank recons and when you're recording and reporting cash. When you guys, a lot of you are running some of the largest systems that are available, in a city or in a county, as compared to, private companies. Many of you are running really big ERP systems like Workday or some of the others that have maybe gone by the wayside. But and so you might have a very complex cash module that you're dealing with, and so we want to touch on that and touch on the difficulties that you run into as you're dealing with different funds and you're dealing with interest allocation and trying to fix things. Trying to fix things in an environment like that can be complex because your cash might be hitting a treasury fund or some other clearing accounts. Maybe you even have a lockbox, which makes things even more complex. But so we'll touch base on that some. Then of course we'll just run through kind of a step-by-step approach to preparing a bank recon. We'll talk about that just at a really elemental level, just so that we're all kind of familiar with the process and what's going on there. Sometimes when you're prepping a bank recon, like with debits and credits, it's easy to get turned around a little bit. Sometimes it feels like you're maybe trying to read something in a mirror. When you're trying to figure out if something's on the bank side or something's on the GL side, if it increases or decreases your actual cash balance at year end. So we'll talk on that a little bit and hopefully come up with some ways to approach that a little bit more clearly. And then we want to talk a little bit about just common year-end closing entries, which for you guys, if you're a city or a county, are really going to be your fair value adjustment. GASB 31 is the fair value. We'll touch on that and sort of talk about that from an auditor's perspective, what we've seen, especially since COVID, related to that. And we also want to talk some about interest allocations, which I'm sure you're all very familiar with. And then, of course, we'll talk about best practices, maybe preparing for your audit. We'll flip to the audit side and talk about, I'll talk about what we do some and best practices, what we look for, and kind of some of the common mistakes and issues that we frequently see and run into as your auditors. We've, over the years, and many of you too, we could probably talk for hours just about the different things that we've ran into and tell stories, unique things, but we'll try to touch on some of those that might be beneficial for everybody. So we're going to have some polling questions today because it's CPE. We're required to. This first one's a little bit fun. Are your organization's reconciliations really reconciled? Hopefully you guys see the pop-up on this and our answers are great. It's are they really reconciled? Is that an absolutely yes? Is it we have small variances every month? Or is it, of course, nobody will ever know? Or it might be you don't even touch reconciliations, and maybe you're thanking your lucky stars for that. But if you could answer this first polling question, that'd be great. And I think we'll get the results for that in just a minute. But speaking to that topic, the opinion on whether or not something's fully reconciled. If you've ever talked with your auditors about a reconciliation, whether it's for cash or for another balance sheet account, you guys might have differing opinions on whether or not it's reconciled. And so, but maybe I'll just take a second to say, as auditors or as accountants, I think the idea of a reconciliation is maybe one of my favorite concepts. I'm getting a little bit older, and any of you that are married, that reconciliation is maybe a good term in relationships too. Being able to, so let's talk a little bit about what that means. I think, when we talk about a reconciliation, usually you've got two sets of records. Two sets of records, and when you line them up, they might have some differences, right? And ultimately, what we're trying to do is identify what those differences are, and then with those differences, we're trying to determine which ones are accurate, and eventually come to a place in the middle where everything lines up and we have a full picture of everything. I think think about reconciliations as an auditor, what I often try to convey to our clients is that when doing a reconciliation, there's a couple of steps. I think the first step is one, figuring out what your two sets of records are. In this case, for us, our two sets of records are, of course, are going to be the bank and our general ledger. And so you have these two sets of records, and what we want to ultimately do is figure out what information they have in common and what information is different. And oftentimes when dealing with clients, I think clients will think, well, I figured out what they have in common and where the differences are, and they feel like maybe that means it's been reconciled. And so going back to this polling question, as we see, the question is, are your reconciliations really reconciled? I think 57% said yes. Some 27 said there's small variances. And then of course 4% nobody will ever know, and thank the lucky 11% of you don't touch reconciliations. But so as an auditor, oftentimes what we see is that people they do come up with a list of differences, and maybe they stop there. And they might feel like they've reconciled it because they've identified the differences. And I think from our perspective, we'd say there's still a couple more steps. I think one, if you've identified the differences, what you want to do is then identify which of them are normal, which are normal and are expected. And typically, most normal differences are really just timing differences. That's what we like to refer to them as, meaning that they're things that haven't hit one of the sets of records yet, but will. So a timing difference. And so you can kind of start to easily sift through your differences and immediately identify which ones are timing differences and which ones aren't. And then at that point, after you know which ones are and aren't, you want to focus on the ones that aren't timing differences. And really, so from our perspective as an auditor, we'd say, one, you want to find the differences. Two, you want to identify which ones are normal and which ones are problematic. And then three, the reconciliation is not truly done until you've dealt with the ones that are problematic, whether that means an adjustment or fixing something in your module or your system that will resolve it. But oftentimes when we come in to do audits, we'll receive a reconciliation, and they look really good. A lot of work's been done on them, but they'll still have items on them that nobody can quite figure out. And that haven't been resolved yet. And I think that what I'd leave with you is that just keep it in mind that maybe that reconciliation is not done until those things are cleared or figured out. And of course, sometimes it's hard to figure those things out, and we'll talk about that a bit too. And sometimes it takes a little bit of time, but. So just basics, when you're doing a cash reconciliation, one of the key things to maybe start with is to gather all the information you need. A bank recon involves a handful of different things. It's got some moving parts, and we're all probably a little bit familiar with this, but the basic things that you're going to need for a bank recon, of course, are your bank statements. You want to gather all the statements that you need for the current month and make sure you have those. Then you want to make sure you can pull a check listing from your ledger. And then we also, you kind of, as you're doing a recon, it's really helpful to have the current month's bank statements, the prior month's bank statements, the current month's check listing and the priors, and then also the prior month's outstanding check listing. A lot of what we're trying to do is compare what happened in the prior month to or what we were expecting to have happen in the prior month to what actually happened in the current month. And likewise, we look at outstanding checks and deposits in transit. So we're always looking at the cash flowing out and the cash that's coming in to us. And so we'll do that for both sides. So get the bank statements, get the check listings, get the previous month's information, the outstanding check listing. Likewise, we'll get a cash receipts listing from our ledger. In the previous month's deposits in transit listing, so what was pending that we were expecting to come in, and then we want to have our GL ready to go. And I'll take just a second to touch on the general ledger. General ledgers for cash can become very complex. They might be one of the more complicated things that that are recorded in the general ledger. Sometimes they're very simple. Again, going back, if you're just a single entity and you have two cash accounts and one or two banks, it might be a pretty simple exercise. But as most of you know, if you're in a city or a county, it's likely that you're trying to spread cash through many funds, and the way that your general ledger does that can be kind of complex. I say that, but it's also understandable. And I think one of the things that we'd like to greatly encourage is that either yourself or somebody in your office is a champion or an expert on how cash flows in that general ledger. I think oftentimes we see and we know that if you have a treasury department, the treasury probably understands cash and understands the accounts and knows that inside and out, the bank accounts, but they might not always understand exactly how the general ledger is functioning or how the auditor controller is accounting for cash. And likewise, in the auditor controller's office, they might kind of have a handle on the GL side of things, but not know everything about cash. It's great if you have somebody that can bridge between those two things. And likewise, it's great if you have somebody that really understands your ledger structure related to cash. A lot of systems, if you use Tyler or Munis or whatever it might be, typically have some clearing accounts, and they also have kind of one fund that that is used to really roll everything up and to look at cash all together as a composite. And then because it's doing that, there are kind of some complex journal entries that will happen between that fund and every other fund to show who the cash really belongs to. And oftentimes that's kind of happening in the background. That a lot of times that fund doesn't get reported on your financial statements. It happens in the background and it sort of collapses when you do your year-end financial statements. But it's important to understand how that works and how those journal entries work, or at least for somebody to really get it and understand it. Because as you're trying to trace cash or fix things that happen in cash, you'll need to know that structure and need to know which funds are maybe getting debited and credited. Oftentimes there's contra accounts and fun things like that, or other clearing accounts. So that's important, and that can be kind of an adventure to deal with. So keep moving here. After we've gathered everything that we need to get going, this is, we've just come up with a simple example. I think we're actually using the same one from last year, so this one might be familiar to you if you saw this last year. But in this example, we've got a checking account and we've also got a savings account, and we're going to reconcile both of them. This example is a little bit unique because I think in this example we're saying that only distributions are coming out of the checking account. So the checking account really just contains checks that are being cut and being sent out, and then we restrict all of our deposits to the savings account. That may or may not be the reality in your circumstances. Probably not. Typically I think what we see is that there's inflows and outflows in any given account. But just to keep it simple, we'll start with this. So again, as we're doing bank reconciliations, we really try to isolate the bank, and then we try to isolate the general ledger. I think, sometimes in our minds, I think what we are thinking that we're doing is just building a bridge between the bank and the general ledger, but that might be a little bit misleading. The way that we'd like you to think about it is to think about the bank by itself, and then maybe think about the general ledger by itself. And what we want to do is adjust each of them. Each of them has its own unique set of adjustments that are needed to get it to the true balance. And so in this example, we have, if you look at just checking here on the screen, we've got our checking beginning balance is $204,000. And so that's where we're starting. And then we know that there are also outstanding checks that bank doesn't know about yet. So that's the idea. So the bank thinks it has 204,000, but we in the finance department know that we've actually cut checks to the tune of 157,000. So we know that the bank doesn't know about those yet, but those are going to hit soon. And so we need to adjust the cash that's really outstanding for those checks. So we're going to take this 204,000 and it's going to get reduced by those checks that have already been dispersed but maybe haven't been cashed yet. And so we know that ultimately the adjusted bank balance should be 46,000. And so we adjust our bank balance for the things the bank doesn't know about. We get to an adjusted bank balance, and we're going to do the same thing for the general ledger. We take the starting amount for the general ledger, and then we figure out the adjustments, the things that the general ledger doesn't know about yet. And we're going to add those in, and that should give us an adjusted general ledger balance. You know, in this example, we don't really have any adjustments that we're aware of to the general ledger. And so our adjusted bank balance is 46,000. Our adjusted general ledger balance is 156,000. Those two numbers should match once we get this all right. Those two numbers should match. So we'll isolate the bank, we'll isolate the general ledger, we'll apply adjustments to each of them individually. And then the end result, the adjusted bank balance and the adjusted GL balance should match. And as we all know, they usually don't. And that's where the reconciliation process really begins. So we start with the normal differences that we're aware of. And these normal differences are really just the timing differences that you know of, outstanding checks and deposits in transit. And that gets us to our adjusted balances. But as unfortunately, we probably had our fingers crossed when we were doing this. We were hoping that our adjusted bank balance was going to match our adjusted GL balance, but they do not. Here, so we have a difference here. We can see down at the bottom of 109,000. So we've got an unknown variance of 109,000 that we need to reconcile. We need to figure out. Just to reinforce it a little bit. So for our savings account, similar. Savings, we have 422,000. We know that there are deposits that are being processed in some department somewhere, but maybe haven't hit the bank yet, of 90,000. So we know that in reality, even though the bank says we have 422,000, we know that we've got another 90,000 that's gonna hit that bank soon, bringing up our grand total to 512. So our adjusted bank balance here is 512,000. Our general ledger, we go through the same exercise. We aren't aware of any adjustments to it, but we know that it doesn't match. And so our adjusted bank balance in this situation, the 512,000, differs from the adjusted GL balance by 9,000. So we've got unknown variances for both of these. We've got 109,000 and 9,000 that we've got to figure out. Normally, and what we would sort of encourage is, as you're setting up your bank reconciliation process, or I'm sure it's probably established, and maybe you guys do this already, you probably do. A great exercise is to have a sort of a checklist of things to troubleshoot when you have variances or things that are unknown. When we're doing a reconciliation, of course, we always start with our outstanding checks in our deposits in transit. Those are kind of easy. Those are things that we know about. Usually your system is tracking those. They're things that have maybe hit your general ledger already, but aren't known to the bank yet. So that's at the top of our list. As we're putting together a list of things to troubleshoot, we start with those. And then a good idea is to then add on 5 or 6 other things to check first. And if you nail down these 5 or 6 things, typically 80-90% of your problems are going to be solved that way. As you kind of work your way down the list and check on certain items, your differences are going to fall out. So we'll look at this next slide and we'll talk a little bit. So again, just high level, the concept is we want to break apart and really isolate and look at the bank itself and the adjustments the bank doesn't know about. And then we want to look at the general ledger and talk about the adjustments the general ledger doesn't talk about or doesn't know about. And then ideally they should match hopefully they meet in the middle and we have a good relationship and everything's happy. If they don't meet in the middle and they don't reconcile, we have problems, right? And if we don't solve those problems, like in relationships, those things fester and they cause us issues later on. So the name of the game is figuring out this unknown variance, and that's what we really want to reconcile. So here in this next example, we've done our homework, and we've looked at these unknown variances of 109,000 and 9,000, and this is what we discovered. As we looked at these variances, it took us a little while, but we discovered that here's a list of detailed items that make up each of these differences. And again, just to reinforce, as I mentioned before, as auditors, we feel like the reconciliation isn't done. There are a couple steps to reconciliations. One, you got to figure out what your unknown differences are. One, you have to identify an unknown difference. Two, then you have to figure out exactly what that unknown difference consists of. And then three, the final step that we'll talk about in a little bit is then you got to fix it. And so we'll talk through that in this example. So here we've got a GL variance of 109,000. As our staff did some great research, what we found was that this 109,000 consists of we have a positive $5 of interest that hasn't quite been recorded yet, isn't known about. It hasn't hit the GL. So that's in there. We found this tranche of checks that I'll talk with you about here. And this tranche of checks, these aren't outstanding checks that we're removing. We've already done that, if you remember. But these are actually checks that we realized hit the wrong account in the GL. And so what we need to do is reverse them from our checking account and plug those in. Or sorry, I've got that backwards. We need to reverse it from our savings and plug those back into our checking account and adjust for those. And then we noticed that we've got global payments. I assume that's a contractor. I'm not sure, but I think that there's a payment that maybe hadn't hit. And there's an insurance payment that is still being processed. And so let's kind of talk about each of these in turn. As mentioned, if you're doing a cash recon, it's a great idea to have a list of the things that you want to troubleshoot first. Of course, we always start with outstanding checks, deposits in transit, and then from there, we usually end up with an unknown variance. And after we have that unknown variance, it's a good idea to start working through our troubleshooting list. And some of the first things that we're going to want to check on are things that are outside the normal process. Almost always our differences are things that somehow landed outside of our normal process. Your county or city probably has a great set of controls that handle most routine issues very, very well, very competently. But the problems arise when we have things that happen outside of the normal circumstances and maybe fall outside those parameters of that control. Some of those things, so interest is something that might get posted automatically or maybe just transferred in automatically to a bank. And as it transfers in automatically, it sort of bypasses your normal cash receipts process. And because of that, your general ledger doesn't pick it up and get it posted into the GL. Likewise, similar thing with these insurance payments or utility payments or other monthly recurring payments that oftentimes we'll see cities or counties, they probably have a really robust process for approving payments on for different vendors, but often they give sort of a blanket approval for utilities or monthly bills that are the same every single month. They know, look, these are coming every month. We don't need to have the auditor controller or a board member or somebody look at it and sign off on it every month. We just pay it. And so those are things that might happen outside of the normal circumstances, might happen outside of your routine controls. They might cause issues. Another similar one that we see on the deposit side is oftentimes there's payments coming in from the state that might be for tax. Maybe they're making distributions to you for taxes or things like that, or maybe for grants, and maybe those happen to just flow into your bank account through an ACH or through a wire. And as those flow in, they might not be picked up by your normal process unless somebody actually looks at that bank statement and figures out what it is and records a journal entry for it. So as we're troubleshooting, again, just to reinforce, uh, one of the key things we want to think about are what are the unique things that hit the ledger or the bank that might not flow through the normal process. And they're usually some type of automated payment or recurring payment, and they miss one or the other. They either are missed by the bank or they get missed by our general ledger. And they end up creating a difference. And once we get it recorded on the other side, it resolves it. But let's talk also just for a second here. The other really frequent issue we run into are if there are any journal entries to cash, or if something strange happened in the ledger to cash. And here, our example of these checks being posted to the wrong ledger account is a great example. So we realized, hey, we cut these 5 checks. They were supposed to hit the checking account, but they accidentally got posted to the savings account. And now we've got a difference. And where sometimes we run into trouble is when you have differences like this that need to be cleaned up on the general ledger. That cleanup process can involve a couple of steps. And I think as auditors, as we start to talk about the things that we frequently run into, that's going to be something that we want to touch on here. Let's really quickly do our next polling question, and maybe you guys can answer from your own experience. Which items have caused you the most heartache or heartburn as you've been doing your deposits, or which things do you see most frequently, or as you're doing your reconciliations? Sorry, are they deposits in transit? Are you having bank errors? Does anybody ever get a bank error in their favor, like Monopoly says? We don't see those very often. Or are they outstanding checks? Is it interest earned and service charges? Bank errors, maybe that's even more like fees. Bank fees are another common one that you see. Again, something that happens outside of the normal process. It just hits the bank. You might not know about it. But if you can just take a second and respond to that, and we'll get those answers in just a minute. So let's talk a little bit more about these common challenges. Again, just to reinforce again, so as we are doing our bank recons, what we want to do is isolate the bank, isolate the general ledger, figure out what adjustments need to be applied to each one. So what does the bank not know about that they should? What does the general ledger not know about that they should? And after you apply those adjustments to each, hopefully they end up being the same amount on both sides. If they're not, then you know that you've got an unknown variance that you have to investigate. You have to be Sherlock Holmes and dig into. And as you go to investigate, it's a great idea to have a list in front of you of common issues that you can troubleshoot. And when we talk about the common issues, one, the outstanding checks and deposits in transit are a given. We probably know about all those very easily. But then from there, what we want to start to think about and look for are things that happen outside of the normal process. And again, those things frequently it could be things that are automatic. If it's an automatic payment or withdrawal from your bank, if it's interest that automatically gets deposited, or a fee that automatically gets withdrawn from your bank, those things might fly under the radar of your general ledger. Likewise, on the general ledger, if there are payments for utilities or things like that automatically get posted and don't go through your normal process, those might get missed as well. So we want to start with our troubleshooting list, look for the things that are outside the normal process. Interest is a big one. Fees are a big one. Utility payments or recurring type of payments are a big one. And then on top of that, there could be errors in where things were posted in the general ledger. And then here's some additional common challenges to add to our troubleshooting list. Returned or voided checks. You guys are all answering your polling question, and I think that it sounds like most people struggle with They see deposits in transit and outstanding checks the most, of course. Some people are running into bank errors or bank issues. And then some are hitting interest or service charges. As an auditor, if I was going to mention, and I know it's different. These are apples and oranges. If I don't really do reconciliations myself that much, but as an auditor, the most frequent big issue that we run into that causes problems in cash are related to probably returned or voided checks. As auditors, we often find that there's a check cut. This is a common scenario for everybody probably. You cut a check for somebody, you send it, they never cash it. They call you up, they say it never came, I didn't see it. And so what ends up happening is typically where people get into trouble is another check gets cut. We cut another check and we send it out to them. They cash it. They're now happy. They got paid. Life's good. But the check that got lost maybe didn't ever get voided. Or instead of voiding it, sometimes what we see is they get to year end and they realize there's a difference in cash, and maybe a journal entry is just recorded to true up the cash, but you still have that voided check on your outstanding check listing. Or it could be that the module that tracks outstanding checks in the general ledger, oftentimes they can become disjointed as well. And they become disjointed in this process when you have voided checks that maybe either got handled in the module but not in the general ledger, or got handled in the general ledger but not the module. So keep that in mind as an auditor. As we've dealt with clients and they've had differences that have been around for 8 months and nobody could figure out, very, very frequently we found that what actually happened was something got missed during this voiding process. Another check was cut, and so now there's really 2 checks out there that the system's tracking, and it's creating a difference because only one of them got cashed, or maybe it got partially cleaned up. But so keep that in mind. That's always at the very top of my list. And then I think that as mentioned, you could have things that that are being recorded into the wrong accounts. You could have, credit cards are interesting and unique. The credit cards are a little bit separate from the cash recon process, but they create timing issues that can be interesting, as those are recorded in the general ledger or maybe not recorded in the general ledger, but maybe hit cash. That's another one to troubleshoot pretty quickly. You might have unrecorded transactions. Unrecorded transactions, we usually see those in instances where oftentimes we see those with really small entities. If a smaller entity has a bank account that maybe the auditor, controller, or the finance department doesn't know about, if they have a district that happens to have a bank account with some cash in it, they might be doing business out of that bank account that maybe never happens to post to the GL, or maybe most of it hits the GL, but from time to time there's something that they cut a check or do something in an emergency, and it never quite reaches the general ledger. So unrecorded transactions, or again, the other one that we run into frequently is departments. Departments sometimes sit on things or don't get things processed timely, or maybe input something incorrectly, and there's inevitably it's very easy to have some disconnects between departments and the finance department just because they're in different places. So that's another great one. So again, and I promise I'll stop repeating myself here in just a minute, but just to reinforce, as we're doing our bank reconciliations, we want to look at the bank and its adjustments. We want to look at the general ledger and its adjustments. Hopefully, after we apply adjustments to both, they match. But if they don't, you have an unknown variance, you want to start troubleshooting. And as you troubleshoot, you want to look for things that are outside of the normal process. Oftentimes interest, oftentimes fees, that kind of thing, or utilities, automatic payments. Look for those things that maybe didn't get recorded. If you still can't figure it out from there, another great place to start is to start looking at your voided checks. See what checks got voided, see what checks maybe got reissued, and then check to see how those were cleaned up. and go have a look at the ledger, have a look at your cash module, and make sure it got fixed on both sides. And then again, uh, also have a look at things that maybe hit the wrong accounts. Maybe double check your credit cards to see if certain things hit AP or recorded as being paid, but maybe didn't get recorded in the bank because they were on a credit card. And then likewise have a look for bank accounts, unrecorded transactions, or things that maybe got stuck or stranded with departments. We sort of, as mentioned, it's kind of like being Sherlock Holmes. You start to investigate and dig into these things a little bit to see what you can resolve. Um, as you guys are doing this, one of the things that we recommend, and a lot of you probably are doing this already, maybe we just want to talk about timing for the cash recon. Cash recons, of course, should be being done monthly at a minimum. Many of you are maybe doing daily cash recons, and we recommend that. Oftentimes people are reconciling deposits daily and that type of thing. Doing it daily is fantastic because you're able to kind of deal with problems as they happen. Otherwise, if you do it at the end of the month, you're dealing with 30 days problems. And some of those things happened 30 days ago and people might not remember. But if you're doing it daily, it's very easy to reach out and ask, or even if it's just a few times a week, very easy to reach out to the departments and say, hey, what happened here? What happened there? It's fresh on everybody's mind. You can talk through it. So doing a daily recon is helpful. And then that way, when you get to the month end recon, it's very easy. It's all really kind of there and ready to go for you. But to do that, typically people are just looking at their daily bank activities online. They're looking at the deposits log that's kept with each of the departments, and as that funnels to the finance office, and then they want to look at the outstanding checks log and also monitor the credit card activities. But we recommend that if you can do it. I know that as we talk about timing, um, and we talk about the audits, that can be a little bit of a sore subject because I know everybody's very short-staffed. But here really quickly is our polling question number 3 as we're starting to talk about timing. As your auditors, uh, we recommend that it's just kind of, it's canon that cash reconciliations are done every single month. As LSL, as we come in and do audits, I think our policy is that if there's a recon that took more than 60 days to get completed, we see that as a deficiency in the controls. Cash really is kind of it's the lifeblood of finance. It's the foundation of everything. Doing those cash recons, I joke a little bit, but it's sort of like the brushing your teeth of finance. If I've got 4 kids. If one of my kids is telling me he's running late and so he's not going to brush his teeth, I immediately grab him by the ear and tell him, you got to brush your teeth. And I would say the same thing about cash recons. Again, I know that it might be a little bit of a sore subject. I know a lot of people or a lot of organizations struggle to get these things done on time for very good reasons. I know that, since COVID, we've all been dealing with lots of turnover. We're short-staffed. You might have new staff. These recons aren't necessarily easy. The people with the institutional knowledge maybe are gone now. And so but just like I would tell my child, if there's something you're going to skip, it definitely shouldn't be the cash recons. If you're late, you still can't skip brushing your teeth, right? So maybe that's kind of a corny example, but cash recons, the thing about it is if you get behind, and I know that we've worked with a lot of entities that have gotten behind before, and it's easy to do. Next thing you know, you're 3 months behind, and then maybe you're 5 months behind, and then lo and behold, or heaven forbid, the person that was supposed to do it at 5 months behind leaves. And then next thing you know, you're 9 months behind. The thing about cash is everything touches cash, right? And we're doing accounting. It's all about cash. So everything is hitting these cash accounts. And if they're not being reconciled timely, there's kind of a plethora of things that could happen that you won't be aware of. Reconciling cash is really kind of your first stop for understanding the health and the hygiene of your department, of your entity. And so and I know it's it's hard with all the different things people have to do, but we reconcile or we recommend that you're always doing these. If and it's really, we know that you're wearing multiple hats, but make it a matter of priority. Do it, do it, do it. If you don't, it'll come back to haunt you. Um, and and uh, and that's probably enough on that. But so let's touch here a little bit on what the auditors are going to be looking for. And we'll move through this pretty quickly just to make sure we have enough time for questions. But so as your auditors are coming in, we're going to go through a similar process as when you're doing your reconciliations. We're going to see if we can, number one, um, we're going to ask you for a listing of all your bank accounts. Uh, we're going to ask for a listing of all your bank accounts and gather that. We're going to do the same thing. We're going to try to gather all the information. We're going to say, hey, we need a listing of all of your bank accounts, every single one. And then we're going to ask you maybe for a copy um, of your fair value adjustment, and then a listing of all GL accounts that have cash in them. Um, then from there, if you've dealt with us before, you know that we're going to confirm. And we typically confirm almost every single account. And maybe you've done that with us before. We often use confirmation.com. Almost everything's done electronically now. You're probably familiar with that. If you're not, your auditor should be able to walk you through the process pretty easily. With these confirmations being electronic, it's gotten much, much easier to do. And then from there, we're gonna ask for your actual bank reconciliations. And when we look at your bank recons, we want, number one, there's really three things we're going to be looking at with your bank recons. Hopefully, your bank recons are done, and we're going to look at when they were done. And as mentioned before, I think we typically think anything past 60 days is really a problem. So hopefully those bank recons were done timely. And then so number one, were the bank recons done on time? Number two, were the bank recons reviewed by someone? A really important internal control is that somebody is reconciling cash who isn't really involved with the the processing, the day-to-day processing of cash, of AP, of deposits, that kind of thing. So you have somebody external reconciling, and then you have even another person that reviews that reconciliation. And with auditors, as you know, our mantra is if you didn't document it, you didn't do it, right? And so when you prepare that reconciliation, you want somebody to sign off or to document that they did that step. And then likewise, when somebody else reviews that reconciliation, you want them to document they did that step. Most frequently, of course, the documentation of that are just signatures on the recon. Usually we're looking to make sure that recon has two signatures. So we're looking for three things usually as auditors. One, did the reconciliations get done timely? Two, was it prepared by someone that's outside the normal process, and then was it reviewed by somebody else? So we're looking for those two signatures on the recon. And then number three, as I've kind of mentioned before, we want to see that that reconciling items were dealt with. We want to make sure that the reconciliation was complete, that you really did identify the differences, and then investigate those and determine which ones were appropriate and which ones maybe weren't. For things that shouldn't be there, we want to make sure that you actually took the steps to clean those things up. We understand, I think, as auditors, maybe a good practice. Sometimes you run into things you don't know how to clean up. A good practice is if you run into something like that and it's June, you're getting close to year end. It doesn't hurt to reach out to your auditors and to ask them about it, or to mention it to them. Tell them, hey, we've got this unique issue. We're trying to figure out how to record this in our system. Then they're aware it's not something that they find on their own. If they find it on their own and you're not aware of it or haven't communicated that, they might call it a finding. So keep that in mind. So this is just an example of one of our work papers. This probably isn't super meaningful for you guys, but we're doing the same thing. We start with the bank balance. We go through, if you look at the top, we go through outstanding items, checks and deposits in transit. We come up with an adjusted bank balance. This is how we do this audit. Maybe the one thing that I would point out to you here is if you go down to the bottom right corner, you can see that our overall difference in cash, when we look at all the cash, at this entity is $360. There's a saying, we often say cash is cash. We say that, auditors say that to each other. And what that really means, in audit, we have the concept of materiality, and we love it. We love when we are able to kind of say, well, you know what, that's probably not big enough to matter. But we use this phrasing, we say cash is cash. And what we really mean when we say that is materiality sort of doesn't matter with cash. Cash almost always needs to be kind of to the penny. If you look at this entity, they've got $67 million. And we were able to tie out everything and get it reconciled down to $360, which is much less than what our normal materiality would be. And this is a difference we can live with. We're okay with this. But with cash, if we've got larger differences, your auditors, even though they might not be traditionally what you consider to be material, your auditors will probably choke on them and say, we've got to figure this out. Again, because cash is kind of the lifeblood of everything, we feel like we really need to nail down cash. Cash is cash. We got to know what it is. We'll probably keep digging for quite a while, especially if there are differences we can't figure out. And you guys might experience that. It might be a little bit obnoxious, but we just see it that way. Cash is almost a different thing than every other thing that you see on your financial statements. It's got to be real close, because it really impacts everything. We can probably just skip past this. I know we're running a little bit short on time, and I think we talked a little bit through this. The main things that we're looking for when we're looking at bank recons, again, just to reinforce, was it done timely within 30 to 60 days? Do those recons. It's like brushing your teeth. You got to do it. Do they have the signatures for the preparer and the approver? And then of course, is it complete? Did you figure out what the differences were, and did you fix them? Of course, we're going to make sure that everything foots, the math all works on that spreadsheet. We're going to make sure that everything ties to the bank, ties to the GL, double check all those things. And then we'll probably look at your outstanding checks and deposits in transit. One more quick plug, and then we'll probably go to questions here, I think, is outstanding checks. If you have a look at your outstanding checks, we normally feel like an outstanding check that is probably beyond 3 months, 4 months, starts to kind of catch our attention. I think in California, the escheatment process says that you really need to deal with outstanding checks, or they need to go through the escheatment process beyond 6 months, which is kind of a whole separate issue. But so keep that in mind. I challenge all you guys to have a glance at your outstanding checks just to see. Maybe you already know, and if you know, no big deal. But if you don't know, look at your outstanding checks list and see how old they get. Look for the oldest ones, and see how old they are. We're going here to polling question number 4. And here's where you can give me some feedback. Do you feel more confident in what you need to prepare for the auditors? Is that an absolutely? I feel the same, or no, I'm still confused. I know as auditors, we aren't always everybody's favorite people, but we like to team with you guys. Hopefully we're working with you, and we add to your process and don't just cause you a heartache. I think that we've probably touched on most of these things, common mistakes and questions, miscommunication, things being late. Your interest allocation can cause issues if that's not done correctly. Let me touch really fast here on fair value adjustment, and then I think we'll go to questions. I know I keep promising that. But fair value adjustments, for those of you that don't know, your entity is probably invested in camp or LAIF or some other investments to try to get a return on the money. Those investments they go up and down, right? The value goes up and down, and as they go up and down, even if you don't sell them, there's this idea of recording the fair value of those investments, and so. In the past, I think a lot of places, because the investments that we're usually in for government are pretty conservative, hopefully there weren't large fluctuations happening. And so in the past, oftentimes those fluctuations in investments, as we look at them, we realize they're not big enough to be considered material. We know what they are, so they're not an unknown, but we would think that, or the county or the city would decide that they weren't really considered to be material. And so we would pass on recording that adjustment each year. In particular, we pass on it because oftentimes if you guys record a fair value adjustment, the first thing you do on day one of the next year is reverse it out. So in some ways, it doesn't represent real cash because you haven't liquidated those investments. So in the past, we would pass on recording that fair value adjustment. It was a lot of work. It would usually just get reversed on day one. Oftentimes, it wasn't material. However, as we all know, since COVID, interesting things have been happening in the world. Interesting things have happened with interest rates, and what we started to see about 3 years ago was that almost all of these fair value adjustments have become material. And depending upon the given year, they probably are going to be material. I'm guessing for the next while. Things, as you guys know, the market's up and it's down. I would say until we have, I don't know what happens. Another election, another who knows what. Things are probably going to keep moving around enough that these fair value adjustments are going to be an issue that's material. And so I would probably just plan to deal with these on an annual basis going forward for quite a while. I know a lot of our clients have implemented accounts that they can use to record this, so it's a little bit more simplified. But in the past, this was something that we didn't necessarily have to do because of materiality. But I think in the future or the near term, it's going to be something that we're living with for a bit. So really quick plug, I think we've got another webinar coming up on July 15th. It's with Riley Greenlee. He's great. Although I love this topic that we've been talking about and think it's the best one, if there was one I was going to recommend to you from all of our webinars, it'd probably be this one, Pension and OPEB. For those of you that deal with Pension and OPEB, you know that that's complex. Riley's awesome. If you work with him, you know him. He's a great teacher, great presenter. He's actually who we use in our firm to teach us about pensions and OPEB. So he's very, very knowledgeable. Give that plug to you. That's going to be a very, very good one to see. So from there, I think that, Cami, maybe we could go to some questions. Let me make sure I've got my polling questions popped up here. And we'll run through. If we don't get to your questions, we apologize. Feel free. I think that you're welcome to contact me or Cami, and she can route you to me. I'm happy to chat with any of you kind of offline after this meeting if we don't get enough time. But we'll start with these. So one of the things that first question, GL cash balance is one of the items you've listed to get started on the bank rec. How can we do a bank rec if we're posting journal entries to prior periods, thus changing the GL cash balance for prior periods? That's a unique question in itself. That might be in general, as auditors and as an accountant, I would say you should never be able to post to prior periods. That's something we run into often. Sometimes people don't understand the importance of that, but you should never be able to post to prior periods. QuickBooks will let you do it. And I think there are some other accounting systems that let you do it. QuickBooks is notorious for that. If you post to a prior period, it changes everything and can cause issues, and you might not realize what's causing it. So I would recommend that you do not do that. Don't post to prior periods. Post things in the current period. Record prior period adjustments to equity if it is from a prior period. Keep that in mind. But it's a great question. I think you are correct. If you're posting things to prior periods, you've got an issue, and that's something you need to avoid. Next question is, what's a reasonable time frame for monthly bank rec? And so I think that question probably came before I started to harp. But I think that, you want to do those bank recs as quickly as you can. Oftentimes it takes you a little bit of time to get those bank statements in. And so the soonest you can really do them is as soon as you have all the statements. But we would recommend you do those as soon as you have the statements, if you can. If you can't, I mean, within reason, as mentioned, we would say 30 days is probably what's the healthiest. Beyond 60 days, we feel concerned about. So definitely within that window of 30 to 60 days. Next question, how can you get a bank rec done within 30 to 60 days if your GL isn't closed for more than 60 days? Well, this is the thing, and that's a great question. But the thing about cash is really all of your cash transactions end on June 30th. Uh, Cash is never going to flow out after that. So you sort of know cash is really settled at that point in time. And so there are many other moving parts, but none of them should truly be cash. They're going to be AP, they're going to be AR, they're going to be accruals, expenses, revenues, those kinds of things that are happening beyond 60 days. But cash really should be static and should stop moving as of June 30th. Anything that happens on July 1 related to cash is for the next year. And so you should be able to nail down that cash. In the audit business, we've often said, hey, they can do cash right away. That's one of those things you could probably do before things are closed. Again, I understand you might have some moving parts in the GL as that takes place, but I think you could do most of that ahead of time. That would be my response there. So materiality threshold of cash, I think maybe I touched on that. Materiality, your auditors are never going to tell you what that is. That's kind of a rule of thumb. But materiality is not a mystery. It's something that you should probably be able to calculate within reason. Even though as an auditor, we can't tell you what our materiality is. I do have my clients call me sometimes and say, hey, look, we've got this adjustment. How do you feel about it? Is this, what they're asking is this material for you? I'm happy to talk with my clients about that, and I'll usually say yes or no, and they might say, is it close, or what can you live with, and we'll talk about that a little bit. But with cash, and this question specifically is asking, do you want to spend hours researching a $200 difference? I would say no. I would say the thing with cash is there are going to be many things that maybe you cannot figure out. Maybe you can't figure out, and maybe it's $200, and you're going to spend more than $200 looking for it. At some point, it does make sense to say, hey, look, we've got a difference in cash. It's small, and we're going to post an adjustment to true it up. We're going to expense it, or we're going to post it to other revenue, and then record that you did that. Be very transparent about doing that. I don't think it's a big deal if you say, look, we wrote off $200 this year. It's clearly immaterial. Now your cash ties, you dealt with the problem, and it doesn't just sit there and fester. But to your question, you don't want to necessarily kill yourself trying to find that $200. At some point you say, look, we're packing up, we're just going to adjust this thing and go home. A sheetman, somebody mentioned in here that a sheetman is 6 months. I may have gotten that right or may not. I know somebody mentions the California Government Code 5007, I think. Look into that. We do have consultants that do work just primarily with this. And at our firm, most firms do. And so if you do have specific questions on a sheetman, we can get you in touch with people that can really help with it. And if you've been through that process, it's a little bit of a headache. But that is, it's code. It's part of the statute. Is it a good idea to follow up with vendors who haven't cashed checks? Yes, absolutely. And then as mentioned, make sure that if you do decide to reissue those checks, you're cleaning up the old ones. A lot of those checks that you're sending to a sheetman are oftentimes they're things that maybe have been reissued already. And maybe you're on top of that. Maybe that's not the case. But yeah, great idea to follow up with them. Again, you don't necessarily need to kill yourself. But I think maybe in the achievement process, they even ask you if you've tried to reach out. How do you know the cash variance difference is okay and okay to live with? One of the things that we talk about sometimes is if you have a difference, it might be a net difference, meaning you might think you have a difference of $200, but maybe it's $100,000 one way and $200 the other way. That's, auditors, we always come up with those extreme examples. I would make sure you understand if something's a net difference, and maybe you're not seeing the entirety of the iceberg kind of thing. But if that's a gross difference and it's only $360, you could probably live with it. But again, what we would recommend is that you clean it up. post an entry, get it off there, just so you're trued up. You don't need to worry about it later. What you don't want is for that to hang around for the next 15 years kind of thing, which is just what you end up seeing in a lot of places. There's a variance that happened. It's been here ever since I started working here. We don't know how to clean it up. Go ahead and clean it up. It's a hassle, but once you clean it up, you feel a lot better. It's not an issue anymore. Okay, last question. If there's small amounts that become material. So again, we talked about cash is cash. We talked about how things are, sometimes our differences might seem small, but they might consist of a couple of material things that are offsetting one another. You want to make sure that you understand things enough to know if that's the case or not. Because if it is, you want to be able to deal with it. Um, so definitely look into it, understand it, and know. Uh, but this question more appropriately, maybe they're asking if we've got a handful of small amounts, do they add up to something that's material? Auditors probably think so. They'd probably say, look, if you have, if our materiality is 20, maybe 40 grand, and you have an adjustment for 10 grand, one for 15 grand, and another one for 2 grand, we're probably going to panic because the way that we kind of see it is that, look, if there's three that we know about, there's probably one more. And if we're getting close to that materiality, there's probably something that we're not aware of that's going to push us over it. If you have a few of them, we're probably going to say it's material. Again, my recommendation is clean it up if you can. Just go ahead and post an adjustment. If it's clearly immaterial, post the adjustment, expense it in the year, get it out of there. If you can't figure it out, troubleshoot it a little bit. Sometimes it doesn't hurt to call your auditors and ask them if they have any suggestions if you can't figure something out. But eventually, sometimes it just makes sense to clean something up and get it off the books. But I think that's it for all of our questions. We really appreciate you guys joining us today. Hopefully it was helpful. Hopefully you could kind of follow my ramblings. Again, Riley is going to be speaking to us coming up in our next presentation, and that'll be very worthwhile. Hope you guys have a great rest of the day.
Thank you, Barrett. That was awesome. Thank you, everyone, for joining us. And look out for that email with the recording and the slides and Barrett's contact information after this later today. Thanks again, everyone.